this video about continuing our little portfolio because I'm so convinced for a temporary little bit of time that this is the future. I had to do, this is somebody else, but we did a little analysis where we put a bunch of buildings in, and each of the buildings have some energy. We have some prices, some programs for the energy efficiency, for solar, for batteries. We put some technology assumptions in, and then we always make a template. We always put our name of our project in. We're able, if we put everything down in our database, if we put them all in single columns, and that's not so hard to do, we'll show you that, then we can get a template built, and that template has to be absolutely flexible, and that's really a big subject of today. So we put the different buildings in. We make a nice little summary sheet. We consolidate all of the month by month. We do all the template on a month by month thing, and then we consolidate that. And we're going to use some formula texts in really kind of nifty little ways. And then we can put a building by building analysis. It's obviously not complete, and then we'll clear the projects and we'll create a portfolio, and we can change our model as we progress. We can put financing together, make it into a corporate model, and do that sort of thing. Okay, so we're in the next video. Actually, I'm going to show you some of this really in this video. I'm going to continue really because I want to make our little project I'm working on a little more complicated. And I want to incorporate tax depreciation and understand that different assets in this portfolio might have some different tax depreciation, and we could use different factors. This happens to be in France, where if you have a 4-year life, you have a different VDB, variable declining balance factor. And then maybe there's some incentives you can take. Sometimes you could take 40% depreciation right off the top. They all moan about their tax rate. 27% isn't that high, I don't think. But if you have an NOL, you only get to take 50% of it. It actually is not, there is no expiration of the NOL in France, but you only get to take 50%. And if we have a monthly model, we want to just do it over 3 periods. So how do we do that? And then how do we do something that's really kind of, I think, important? How do we get some of the actual data? What happens if we have some actual data and we want to take each of these projects and throw in the actual revenues and use this whole thing for asset management, so we can compare actual to forecast? We can create a new forecast. How do we get it in? And then we'll take, I've already talked about the tax depreciation and book depreciation just a little bit. I'll go through that. Oh, I'm talking too fast. I've got to relax. Just relax. People won't hate you. And then we're going to take, and I am struggling theoretically whether ROIC is even worth computing. What good is it? And when you go through corporations who take write-offs all the time and then buy companies, it starts to become completely meaningless. And for project finance, of course, we can't compute it because of the depreciation distortion, but we can undistort the depreciation, and at least have a performance measure and start to think about how we really should value all sorts of things when all these McKinsey people say this ROIC is the foundation for everything, and I like that a little bit. And then we're going to show you how to really get this thing where you have a monthly model and then you got to sum things up. God, I have to do this all the time nowadays. all the stupid time. And how do we just very quickly kind of create a little flag variable that says this is the end of the quarter, or this is the date that we repay the loan. And then we count it. So that's the first quarter, 1, 2, 3, second quarter, 1, 2, no, 1 for the first quarter as soon as we hit it, then 2 for the second quarter, 3 for the third quarter, and then we use a sum if. And with a sum if, it works really kind of cool. And then you just multiply that by a flag. So we're going to show you how to do that. Whew. And then we're going to put it in the portfolio like I kind of introduced in the next video. But I just want to show you where we're going. So you remember this one. I made up a whole bunch of leases. I call them projects, I suppose. These are our batteries. So the other one was energy efficiency. We could have solar projects. We could have hydrogen projects. We could have, well, God knows what, anything, least real estate projects. And we put some actual data in, and I even did a little Monte Carlo simulation, which is kind of worthless. I'll give you my opinions on how worthless that really is later. Okay, so the first thing is let's review what we're going to do. So we're going to make a little depreciation table, and that table will change depending on the life of the asset. And then everything, you know, people tend to get fancy with these financial models. We're going to take this portfolio and consolidate it. And when we consolidate it, we're going to use that sum start to end. And that doesn't work as perfectly as you might think. And then we're going to put a project by project summary in here where we put things like the IRRs, and we put our actuals, and see maybe that's where we can use a little bit of ROIC to see how our different projects are working. Okay. And then I have to get a word out now. We're of course going to then make our little start and end and create projects and delete projects. I even have a little time thing where we see how long it really takes to do all this. And when I started to do this one, I thought, oh no, you know, this is too simple. We're going to make it a little more complicated. So I put some depreciation and taxes, and how many? I've got about 10 things on the top, and so why don't I put this here? By the way, okay, I'm not going to do a digression. I'll do the digression later on. You know, if you want to remove links from the same sheet, that irritating, horrible thing where you suddenly have the sheet name of this sheet in, you can do that. You can, if you have some external links and you want to find them, you can do that. If you want to mark the cells with no dependents, you can do that. You can make this table of contents, which I guess we'll make later, okay? All right, so we kind of, where I left off last time, we kind of got a project IRR, okay? And this time, we're going to get some depreciation. And if you remember, just in case, I want to make these things a little bit independent, but if we put project 2, then every, you know, all the inputs are here in green. Oh no, you know, last time I reversed the font to really dramatically kind of show. I don't know if that's good or bad or crappy or whatever. I really tried to say exactly which inputs come from a different sheet. So there's no doubt anymore about that. Okay? And we get different inputs from these green ones. They all come from the index function, and you put the project in. Just to remind you, sorry to be redundant, don't yell at me. Well, you can yell at your video and turn it off. That's all you can really do anyway. Okay, and then what we're going to do is put some NOLs, some expiring NOLs. I even put some France tax laws here. Where did I put that? Here, and I even put a little graph. This is really some of the nice stuff. Somebody made a graph on which countries have an expiring NOL, France and England and Deutschland. Don't Suisse, c'est ça, le set. You have 7 years, okay? So different countries. Now, so we're going to work through. Why don't I work through some of the issues one by one? I haven't really practiced this. I probably should, but everything's in the template, and I just wanted to make this a little more complicated so you can see things and start thinking about things. So the first thing is we have different economic lives. Now, I put the inputs up here. If we have again the total cycles in our battery, uh, 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 and this is again what an idiotic thing I should do over the life. If we only would put here 2,000 cycles, maybe I'm going to go really extreme and put 1,500, and then we have a shorter well, we then have to also let's keep the cycles per year the same about, you know. Ooh, let's even put this a little bit 350 and 350, and you want to be able to change these, and then we've got something with a 4-year life, something with a 7-year life, something with a 10-year life. Okay, and then we make our template extremely flexible. We take our total life, and then we'll take just a depreciation rate over the entire life. I don't think I have to do that again. Then we multiply this by the date, and let's start with project one. So you remember everything kind of changes, and so this had a 120 or a 10-year life. I think that's divided by 12. So we'll just put it over, and luckily we have a life flag here. So we just multiply this one by the life flag, okay? And then we're not finished. And then we said, oh, no, no, no. When we get to this residual period, we're going to just deduct everything. So we're going to assume we get paid fully in that residual period. And I went slamming and bamming and went crazy to say that, well, you know, here's the end of the lease period. If I can find it, here it is. We look upstairs right there. It's the end of the lease period. And then then we take this residual, we take the depreciation over the lease period, and I made this too simplistic, didn't I? We need to change this just a bit because it's too, you know. Okay, let's make it 350. It's more than 350 cycles would be more than every day in a year. And then so our lifetime is a little bit shorter, and we get 41% of our depreciation in that last year. So you take this one and you put it over here, and you don't worry about some fast bullshit. Sorry about that, Kenny, but people are going driving crazy with this stuff. Oh, this bureaucratic, oh no, you can't do that. That's totally violation because it has to come from a blah input sheet. Oh, whatever. Be a little creative, please. Oh, I'm getting blood pressure. I'm going to probably die by the end of this video. Now, so then you just put that extra thing here, and then we have our book depreciation rate, which is kind of a worthless thing to calculate. And then we'll get to the tax depreciation, and we might have some incentive tax depreciation. And this time I took this not from our project by project, I took it from a general tax sheet. Oh no, we better color this one up. Jeez, how could we not do that? Okay, and that's probably all at that. Sorry again, Kenny, but this is not fast modeling standards because this had to be in some input S sheet or some input C sheet. And oh no, it doesn't do that because it doesn't make sense to do it. Oh God, what did I do? Why didn't this color the inputs if it doesn't? It must. Are these not inputs? Yeah, it colored the inputs. Okay, good. Okay, so those are some of our tax inputs, and I put the expiration, like I said, and we said we could maybe take a 40% depreciation in the beginning, and then I said, okay, well, let's just put that down here as some tax stuff, and we could say no, we put a false here, so let's not take a. Oh, I did it. I did it kind of differently. For let's put this as true. This is false. How about we do this? Okay, and that's enough. Okay, good. All right, some of them are true. So who knows why that actually, I think it depended on the year you went in service. So this officially probably wouldn't qualify for this stuff. Okay, but if it's true, then we're going to take 40% of the depreciation right in the very first year. And I might have a mistake on this. 30%. Okay, I put that. And then the remaining depreciation is 70%. And of that remaining depreciation, and look at this, I did not put the first year tax depreciation in here. So I made another mistake, and maybe I should have put this times this up here, and then I should have added this depreciation. We have this horrible formula. I'm sorry about this formula. I'm going to explain it right now. And it's all in green, so you can't see it. That kind of sucks. And then we're going to put this in if you remember, we have just a 1-year development period, and we multiply this by the starting point. Now, please, you could put a whole page of time flags somehow. So we have this. Oh no, do I? What did I do here? K5, which is the initial lease term, so it should have been this one. Sorry about that. Okay, so we have a kind of our first year depreciation. If it actually might really occur in the next year. So if we're really a little more precise, we take it in this period. So okay, I fixed that. Okay, so there's our first year depreciation. Now let's understand this index. Okay, so if you have, and I'm trying to explain just a little bit about some tax depreciation issues as well here. We have a 9-year life, a 7-year life, and then this is a little bit of a lookup. In the French system, it seems that we have a different starting point for our variable declining balance if we have a different life. And it's either 1.75, it looks like, or 2. Remember this. So this is our very nice country, really. And if it's more than 6 years, it's 2.25. If it's 3 or 4 years. So what we could do, I suppose, is let's see if we can make one really, really short, just to illustrate. So project 3 is going to have the cycles over the life. I really should have put that in there a lot before. Only 1,000 cycles over the whole life. And we're going to use 350. And our lease term up here, where did I put our lease term? Our lease term, well, that's kind of short anyway. So let's just make it 20 months. So now we have a 3-year life, and this is really, really bad because I should have put this let's redo this lookup since I probably made a mistake. We're going to take this lookup, and then what I suggest you do is you set up something like this. So if it goes from, I put the wrong thing in there. So if it goes from 0 to 3, and then of course use the whole line so you don't have to stick F4s all the time in here. And the actual taxes were oh, that's the old taxes, 1.25, 1.75, 2.25. So I did this a little bit wrong. Okay. Come on, come on, come on, come on, come on. 1.25. Yeah, no, that's okay. And then do we have anything that's greater than 6? I did this wrong. Okay, 0 to 4 is 1.25, excuse me. And then as soon as we hit, oh, sorry about this. As soon as we hit 6, we're on this one. This should have been 4. And this should have, we didn't really need the zeros. I'll put it like this. So I made another mistake on purpose so I could really be able to explain this to you better. And I should maybe be turning off the stupid video, but now we have different ones. And then we use this VDB. And if you use the VDB, you put VDB, and it's nice. And you can use it, and you can mimic just about any of the tax stuff. And then you go up to the life. You don't need to, yes, you need a F4 on the life. And did I put no, look at this. Maybe it's time for me to stop in my life. And then we put this, and then this, you got this pane with the start period as the prior one, and then the end period as the next one, so I shouldn't have really done it. And then you put in this factor. And then I'm going to make it like this, and then you just copy it down. Okay, and then we get a num, so we put it if error. Some people say never use if error, because if you have a reference down there, it'll suddenly, it'll get rid of it. And you know, okay, and then we can go all the way across. Oh, did I do something wrong? Of course I did something wrong. I didn't put the dollar signs on this like all these young people are so good at putting dollar signs on stuff. And I'm not. Sorry about that. I don't know why I'm not, but whatever. So we have hopefully a different, and of course I didn't put this one too. So somebody is purposely saying, God, you fucking idiot, you stupid one, because then we get different depreciation patterns depending on the lives. And then when we do this, when we put it in this, now this is a block, okay, and we're going to use an index. And when we use an index, the row number is this. We'll put this for the row number, and that row number happens to be the age of the project, and we'll have to divide it by 12. And the column number is this project number, and this project number we have in our template. So whenever you have some multiple kind of data like this, and why don't I just do it here? I'll put index. And then what we first do, and sometimes you could name this range. I used to be so against naming ranges except for macros, but whatever, you could name it. And then you go back to the template, and the first thing you do is you go upstairs and get the age of the project in years. That's the row number, and row always comes first. And the column number is not this. I made a mistake. The column number is this thing. Don't forget to press the F4 button. And it's not a good idea to make this a named range. I discovered that by accident. And, of course, I made another mistake, really, because we should only compute this if we'll just do an if like that. What that means is if that's not equal to 0. And if you want to do that, you could divide it by faults and all that stuff. And what did I do wrong? This is index, and we took it from that one. And this time I'm going to pause. Okay, and I'm just going a little bit quickly, and really we want to start with period 1. So we want to go to this one, and I've just made an executive decision here. I'm going to do this in 2 goes. Okay, and I just did it wrong again. Let's start in period 1, and then press F4. And it's good to practice again. Bullshit. And then we put this one up here, and then we put this number. And this number is basically the first project minus, the starting point, so minus 6 or something like that, I think. And then you press F4, and now we get our 25% for the first year. 12, oh, damn. And I use this. We've got 1 year, 2. Totally embarrassing. I don't feel like turning off the video though, so I'm going to divide that by 12 to get the thing. Oh no, I've got to take this. Oh, that's not. Oh shoot. Okay, let's finish this. So, oh God, it's getting to be a long formula, but we have to also multiply this one instead of just by since we have that incentive depreciation, we have to take the only take the remainder times 70%, of course, and then we add this together, and it's not summing up to 100. So shoot. Okay, okay, I had to round the life down, and I got it. And then I've got to finish this. I've got to finish this, and maybe I drank 1 beer, and maybe I'm so old. If I drink 1 beer and then try to make a video, it just falls apart. And then we get our total. Maybe there's I don't know. I think when you're young, you can have a little something when you make a model. If you don't believe it, I'm sorry. And then we get our tax depreciation with a residual. We have a little tiny bit of residual, the same way we did book depreciation. And then we get our book depreciation and our tax depreciation, and we take our EBITDA, which is just our right now we computed this in the last video. We got our EBITDA. This is from our lease revenues or whatever, and then we have a net operating loss. And normally we have a net operating loss, and you go to the opening balance, and if it's you take the maximum of 0, and you have to account for this tax, the fact that you might not get to push it all forward. That's a big deal. And you have this big tax loss, and it could be the case that first of all, there are 2 things. We should really do the NOL on a consolidated basis. I'm just doing it on a periodic basis so you can kind of get a sense of the individual project IRR, but we got to be really careful with that. So number 1, that might not be the case, but if we can't carry it all forward, it might not even be that good to take that big tax incentive that we just did anyway. And then I'm going to just skip over this because I've redone the expiration of the NOL. And look at this. I put a really big, long expiration date. and did something really bad, at least our generic macros caught that. So if we do it for, it's 48 months, and then we can't just do an offset to take the NOL. We have to see if we've taken some NOL before. So we can't just look backwards 48 months. We have to look backwards and see how much NOL we took already. And that's all in here. And then if you do an expired NOL, you have to put another less expired NOL here. And that's all I'm going to say about it. All I'm going to say about it. And then, okay, I'm going to try to finish this. Look at me. I'm going to talk a little bit more quickly. We put our tax rates in, and then we get our taxes accrued. And eventually we start paying some taxes after the NOL. Where's our, this is, we should look up here at this NOL over here. And when it's the NOL stops, then we start paying some taxes. And we pay monthly taxes, and then here is the big deal. I'm just going to show you this. Step one, make it, I said if the month is, if it's, you divide by 3 and you get a 0, then it's the quarter we have to pay the taxes. 1, 2, 3, 1, 2, 3, 4 quarters in a year. Okay, that's not so bad. We use the mod function. And then you say, okay, let's take the last year, the last time, and put +1, but we're only going to do it when we have our project life. We're not going to start adding things without the project life, and then we have a 1. It doesn't, that last thing wouldn't be that necessary. 3 2s, 3 3s, 3 4s, 3 5s, 3 6s. So far, so good. So far, so good. And then you want to just stick it in that quarterly period. And instead of using offset, I don't think all this malarkey. Oh, that's somebody else says that. All this crap, all this rubbish about offset being so bad. This sum if will have the same problems of the offset with it being a volatile function and all that crap. It's real, mainly crap, I really believe. But we count. So we go at the sum if and we click on this whole counter, and then we use the same thing. Let's do it. Equals sum if. Go up here, take the whole line, go up 1, take that 1, and then go up to the taxes accrued. Take the whole line. And then when you do that, look at this. I'm acting like it's really easy, but it took me so long to do. And then we have 1, 2, 3 159s. And if you go up here, that's for the first period. And then we have 1, 2, 3 602s. And that's when we sum up these down here at 602. And then we have 1, 2, 3 of the next one. And then all you have to do, I say all you have to do, I get this wrong so often, is you multiply it not by this one. You don't multiply it by this one, you multiply it by the next one. Okay, and then let's see if I screwed it up, but then it puts it in the, please, ooh, here's the 159, and did it do it in the wrong one? Did I do it in the wrong one? Shoot. 159, 200. Yes, I did it in the wrong one. This should have been 200, and I should have taken, it should have been this one, and I should have multiplied it. I get to guess I should have multiplied it by this. Let's see if that works. Ah, shoot! See, this is what I mess up every time. And it's such a good little technique, and I always know that you should move it around. Yes, it worked. No, it didn't. Damn. Ah, crap. One more time. Okay. I was right the first time. Oh, stupid. Here, this we have 3/16, and for the last 16, it's this one, and that's these three together. So the rule is you use the next true, not the first two. So you use that counter, that little true false, the counter, then you use the sum if on the same thing, and that's really easy to do. And then you put it in the next one, not the current one or the last one. Good. And then we can get our cash flow after tax, and we can get our IRR after tax. And let's just do something. This is 506. If it wasn't for this 50% thing, oh, that's zero. No, if this was 100%, so, oh God, it would be 5.47. So that actually makes a little bit of a difference, and if we do that on a consolidated basis, we'll get a very different answer. Now, uh, um, uh, 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 there was one other thing I was going to do here. Okay. We get, I know. Ooh, the taxes accrued. If you have this little 50% thing in this NOL, so you push it up forward by 50%, when you use the adjusted EBT, in the old days, I used to take the EBT, 87, plus the amount we push forward minus the amount we use. We can't use plus the amount we push forward anymore. You can't use this one anymore. You'd have to divide by 0.5, so you can just put the maximum of with a number or zero. Otherwise, you'd get you wouldn't get a zero number. Let me just put it that way. So that's that one. So there's a little bit on taxes. Then let's kind of finish this up. And then what I did then is once we have the after-tax IRR, we put it on a monthly basis, and then we get the NPV, regular NPV, no XNPV, please, no. And then you get the NPV of the next period cash flows at the IRR, at the after-tax IRR, and this is up here, this is the after-tax cash flow, which includes the EBITDA minus the CapEx minus the taxes you pay. Okay, that's all that is. And then you get economic depreciation, and economic depreciation is the value in this year, the last year minus the value in this year. And I multiplied it by the life flag. And it gives us the total CapEx. And that economic depreciation is a brilliant thing to do, because then you can compute the NOPAT using I call it the economic NOPAT, and it gives you the same ROIC as the IRR. That's what it does. How wonderful that is. And how bad accounting is, and how bad all of this financial McKinsey BS is without telling you that, because if you use straight line depreciation, it doesn't work. Okay. And then we can make our little balance sheet. And I'm just trying to make a little bit of a longer, more flexible template to show you add lines, subtract lines, you do all your stuff in this in this template. And then I said, no, let's take some actuals. And for the actuals, here I made another thing. I said, okay, let's down here, just the same sort of way we did the depreciation. This is when the project started. Now I put some, who cares about a little simulation I did. I put if I put 2, I put some volatility in. Yeah, let's leave that volatility in. Okay, and then I had different ones with a trend and volatility. And so you can see kind of how to do it, and a normal distribution and volatility and all of this. And I don't want to go into this. And these are the dates the project started. You can see 1 September 23, and it's actually really 1 month after that. I think, oh no, I better leave that in for now. And then so on and so forth. And then I said, no. Oh, we get to here, 1 September 24, that's when we're finished. So somewhere, I should have, this doesn't depend on the project. Somewhere over here, I put the 1 September 24 is the end of the holding period, and then we put in an actual period flag. And we get that from the holding period, and you just say, okay, that's just, it stops then. And that way you can change that month by month, and then you do that same index thing. And this index thing, I don't want to go through again, please. It's just like the other one. We take a big range name, and this time I put this date in, so it starts at the very first date, second date, third date. That's how we set it up. And the big theme here is that you can put anything you want, and you just got to make it kind of go down. It's not exactly a fast modeling standard criteria or smart modeling, blah 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 blah. Okay, but it's a creative, hopefully, thing to do. It's not that creative. And then we get our actual in. Where is our actual? Down here. And we colored that. So that's our first one. And if we put our project 2 in, we get the next one. And uh-oh, that didn't start for a while after. And then I've got some divide by zeros that are really pissing me off. Where were the divide by zeros? Just have one beer. One beer. One beer. Why is that? Plant value using after tax IRR. Oh shoot. Okay. Okay. I'm gonna have to pause again. Okay. Oh shoot. I made a mistake again on this sum if. I had this counter has to keep going. You can't just stop this counter. Uh, uh, at the end of the life. Okay, you can look at that. The file will be on the website. Don't, Jose has to get it up there right away. I'm gonna get it. It's gonna take me another video or two to get it. Okay, just one, I think. Okay, then. Okay, so we got the actuals in here, and now I'm just going to do something quick discussion about the actuals. Let's go back to project 1. Okay, I put my Monte Carlo simulation in there. Now, if you wanted to do a really simple forecast, you'd call it exponential smoothing. I remember in '82 when I kind of introduced this to some company I was working. Oh, I'm doing exponential smooth. Ooh, exponential smoothing. All you do is you take the last forecast and multiply it, the current value multiply it by zero point 0.3, the last forecast, and then you kind of get a weighted average between the last forecast and the current value. And then you can take instead of going, if you've got some actual data, instead of going back to this obsolete kind of forecast you had for the revenues, you probably should use the actual data and then gradually get it back kind of to an average. Now, okay, so then I put this actual and forecast revenues in there, and you can say, okay, however you do it. I don't want to belabor that really too much. And then we can take our residual value as a percent of our lease rate and make a analysis of that, and then we can put all the taxes again using the actuals, so we have a few more lines now, so we've got kind of a original forecast and an actual together. And then oh, I need to be able to press this calculate sheet, right? Okay, and why can't I do that again? Okay, oops. Uh, because I can't press F9 with a video on, and that just is irritating as anything. Okay, and I'm getting negative IRRs here, and I'm gonna pause one more time, the last pause. Okay, when we changed the life around the I had to change the starting value. It was no big deal, promise you. And then so this is our IRR right now if we have if we have our forecast after tax IRR, and this is the same IRR. Now, and all I did was I put a different number up here, and then I put no volatility. If I put 20% volatility in, okay, I'm going to have the same stupid problem where I can't just recompute. We might get, when we use the actual and forecast, a 10% IRR. And what you can do now is see period by period kind of what the ROIC is. Now, if I let me see if I can do that again. If I recalculate now, still got about the same, and recalculate, then I get a lower IRR. And this time you can use the economic depreciation and get the ROIC. When you use the economic depreciation, use exactly the same thing we did before. The NOPAT is the EBITDA minus the economic depreciation minus the taxes. That's we can call that economic NOPAT. And then you can get the value of the asset and get the month by month ROIC, and then to raise it to 12 period minus 1 to get it the period by period. And then you can look at your performance on a period by period level. And I guess if you're McKinsey, you say, we should compare this to the WACC, or, the interesting part was if you're making a forecast, you can kind of assess whether you think economic conditions have changed and you can keep earning this return. That's, I guess, the way I would explain it. It's, for me, the hardest thing now to explain is I know this is the right way to do an ROIC. I know you shouldn't distort it with the stupid, I hate them, the write-offs. I know that you probably should, for a company, compute an ROIC if you could. You can't do that, but with and without acquisition, you don't want to mess it up with all the acquisitions to see what the assets are really earning. And then you can kind of look at trends, and you can think about whether this ROI is sustainable, why it's, if they're earning really a high level, you use your judgment to think, is competition coming in or not, and blah, 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 blah. And that's it. So now we have, and the real idea of this was to make a longer template. And now what we're going to do is consolidate this. And I'm going to grab different numbers and we're going to make a consolidation, and we can look at the ROIC for our whole portfolio. And we can look at some of these factors and put them on a project 1 to project 20 or whatever, and look at each of the projects and really start evaluating them. So that's kind of the last thing about the template. But again, the template's the important thing. Consolidation and making the summaries and all that, that's the easy part. Okay, enough.